Hi everyone, David here. That's a really old picture. I've got to update that. That's a shocker. I'm going to talk to you about some simple ways to raise money at the moment. So obviously the funding environment has changed dramatically over the last couple of years. I'm going to pitch into these three, but on that previous slide that Steve showed, I've been raising money for businesses either as a CFO, I've trained as an accountant and came up through that route, or as COO, or running my own businesses for 15 years. I've done nearly all of the things on that other slide. I think for today's audience, I've had a good look through all the companies that you're at. I think these three are probably the simplest ways at the moment to raise finance, and we'll go through them individually. The first one is revenue-based finance. I didn't quite realise when I was going to do this talk that I'd actually have the owner of Wayflyer sitting in front of me. And Wayflyer in the middle there are actually one of the biggest revenue-based finance funders in the UK at the moment. There are other providers of revenue-based finance. So I just put on here, we are uncapped. I've used them before. That's the main reason for that. And I also wanted to say on here, Amazon, because some of you here do have reasonably sized Amazon businesses, and it's not very apparent through Amazon themselves that they will do this for you. They'll also be on my next slide when I talk about inventory-based finance, which is like stock basically. They'll also do that for you. If you've got an account manager at Amazon, it's definitely worth having a conversation with them, because they won't immediately tell you that they can do this for you, but they can do it, and they will, especially if you've had maybe 18 months to 2 years worth of trading history with them, and they're actually quite good on terms. So that's definitely worth a conversation. But if we look at revenue-based finance, this is probably the easiest way of raising money at the moment, primarily because they can be really quick with their decisions, and they've got a really fixed set of parameters upon which they're going to lend to you. So what they'll do is they will want to plug into all of your systems and data. So all of your front ends, if you're running Shopify, if you're running Amazon, they're going to want for you to connect those accounts. They're going to go in and have a look through all of the data that you've got. So you've got to be happy with them doing that. They also want to look at your bank account as well and look at profitability and cash flow and things like that. But it enables them to make really snappy decisions and help you if you're in a pinch. Typically for what we've seen used with the brands that we either invest into or our own brands is for if you're looking to raise finance for inventory, so you're going to go on a big stock push, you're coming up to a big sale period, you want to get stock in for that, or you're just growing really quickly and you need that working capital, they can help on this. So what they'll do is, and I'm not going to ask Simon to say this now, but what we've seen in some of our investee companies is that they'll typically do 1 to 2 months worth of funding for you. So if you're a 100k a month business, they might give you 100k up to 200k of finance. What will then happen is they'll ask you for repayment terms somewhere between 7 to 20% of your revenue per day. So they ask for a daily repayment to get that money back from you. In essence, they're looking at your revenue flow, and as long as you've got a stable revenue or a growing revenue, then they will look at that and say, okay, we can trust that's going to continue for the future, and therefore that's what we're securitizing this lending against, and we're going to ask you that back from you in 7% or 20%, somewhere in that region per day. The way they'll charge for it is on a fee mechanism. So a lot of us will be used to, say, mortgages, getting loans from banks where you get an interest rate. This is actually based on a fee. So that will be 6 to 18% of the amount you borrow up front, okay? So my little warning sign on this one is just to make sure that you do those calculations, because when they give you the funding requirements, as they did for one of our brands, you'll get the amount you can lend, how much they're going to want back from you on a daily basis, and what that fee is going to be. You just need to go through and make sure that you do the maths to say, okay, actually, if I do pay back at this level, let's say they want you to pay back at 20% a day, how long, given my normal run rate of revenue, is it going to take me to pay that back? Maybe it's 3 months, maybe it's 4 months, and then just remember that fee is just for that period. So if you wanted to, let's say you took 100k and you wanted to, they're going to ask you to pay that back on 20%, it's going to take you 3 or 4 months, but then you wanted that 100k again in the future, actually you're going to pay that fee again. So if you wanted to have that 100k for the full year, let's say, you might end up borrowing that 3 or 4 times. Therefore, your overall rate is going to be much higher than the initial quoted amount, which might be, say, 6%. You make sure that you're looking at it on a like-for-like basis versus the other options that you've got. Typically, you'll run over 3 to 12 months, and then that will be 5 minutes, great. And then that will be based on what your revenue run rate is like, okay? And that is a real benefit of this, is that as your revenues go up and down, the repayment from this goes up and down as well, okay? So if you go into a slump for whatever reason, you stock out of your top product, actually those repayments are going to fall. It's not going to be a fixed repayment that's eating into your cash flow. It's going to really help you to go through that process. A couple of brands that we know of and have worked with who have used this, Current Body and Buddy and Lola. So that was probably the easiest one in terms of revenue-based finance. Inventory-based finance or stock-based finance is probably the next one. A little bit more complicated, but not too much. Again, Amazon will do this for you if you speak to them about it. iWalker and Fleximize are two big brands who do it. iWalker in particular, they now call it, I think, a flexible-based loan. It used to be called inventory finance, but they've called it a flexible loan now, so worth speaking to them about that. On this one, it's a real growth strategy, okay? So this is where they'll be looking at you and saying, if you're a stock-based business and you've got stock sitting in warehouses, it either can be your own warehouse, it can be a third party, it can be Amazon, as long as you can prove you own the stock while it's there, then they'll be happy to lend to you against that stock. So you've got basically cash sitting in that warehouse, and they'll say, okay, how much cash have you got? What they're really trying to figure out is how much, if it all went downhill, how much could we sell this cash, so your stock for, and how much cash would we get back? And they'll lend you a percentage of your current stock value. Really useful if you are growing, okay, because you may need more stock because it's turning over really quickly. Again, like you might have big sale periods coming up that you want to fund. The reason I say it's all about growth is really about the 2% fee, because it's 2% a month for inventory finance. So it can be very useful as you're in that growth period. But if you're not, or it's slowing down, then again, really worthwhile figuring out whether those type of interest rates are going to be the right level for you versus anything else that you might be able to secure under other funding routes, either revenue-based finance or what I'll talk about in a second. So the last one, and probably one, in fact, who here has actually done with their brand revenue-based finance? Just a few. Has anyone done inventory-based finance? Just a few. Has anyone done brand bonds or even heard of it? No. Okay, so this is less used because, I think primarily because there's no central provider of this. Okay, so it's actually down to us as brand owners to do this if we want to. It's not like you can go to a third party like a Wayflyer or an iWalker to do this for you. We're doing it as the brand. In essence, it's like a normal loan. Okay, it's like a bank loan that you would normally get. You're going out to either your customers or other high net worth individuals who are interested in your business and offering them a loan with reasonable rates. It is a real win-win. Okay, so we have done this with Buddy and Lola. I'll talk about Freddie Flowers in a second. They were probably the proponents of it. And you are able to give people who are really interested in your brand and like what you're doing a great interest rate on what they're doing. So for Buddy and Lola, we offer 7% or 9%, depending on whether they invest on a 3-year or 5-year term. And they love what we're doing, right? So they're really happy to get that return rate. And for us, we're getting a 3 to 5 year term loan with a reasonable interest rate. So that works really well for us as well. They will then talk to their friends about it. You'll have different conversations. They'll talk to other investors if they're high net worth individuals. And we've had, so I'm getting a 1-minute warning. This is always good. And we've had lots of great conversations at Buddy and Lola with other investors because they've been introduced to this concept just through us doing the bond. Freddie Flowers started it, and they did a really interesting one, which may be of interest to you guys, which is they did 5%. This is probably about 7 years ago, so they did a lower interest rate. They went at 5% cash, or you could switch it and you could do cash and flowers as part of your repayment. So cash and the product that they already loved. So really good at doing the brand buy-in bit, because that's what you get. You start creating a network of people who really love your brand, not only for what it does, but also from a monetary point of view. And that opens up a world of different conversations. The one thing I'd say about it is that it is more work, okay? Because when you're with Wayflyer, when you're with iWalker, they're doing all that work for you. You will get the money. They're going to take the money back from you in terms of the repayments. But for here, you're going to actually have to do the administration of it. That will be things like setting up a loan template form. That will be things like making sure you're paying them interest back on a monthly, quarterly, annual basis, whatever they've requested, and then making sure that you have organised yourself to make that capital repayment at the end of the term. Having done it with Buddy and Lola, the downside of that admin is absolutely nowhere near the upside that you get from the community, the buy-in, the brand association that people have with you. So definitely something that we're thinking about. And if any of you want to talk about that and how to do it, please come and just grab me after this. I'm really happy to talk about it. It's been fantastic for us. So hopefully that has been helpful in terms of 3 simple ways to try and raise cash in the current market. Move on to the next bit.
Thanks, David. Hope that was useful. So angel investing, one of the best returning asset classes. So if you're thinking about getting investment into your business, loads of benefits, which I'm not going to go into, but from a tax point of view for higher net worth and sophisticated investors, you can get, if a business fails, they can get depending on their tax bracket, up to 70% of their money returned to them. Okay, they can also get capital gains tax that they've paid or were going to pay, and actually use some of that capital gains tax in angel investments. All right, so it's a super valuable thing from an investor point of view, and then from a brand perspective. Okay, if you can get this, there's a process to go through. You can get advanced assurance and then full EIS approval. But if you are thinking about raising equity from investors, try, if you can, to get it EIS compliant. Okay, so we are into the D2C den. Please give, he's got 10 minutes, a massive round of applause for Ollie from Space Goods.